There we are. Hello. Welcome to Be the Boss of Your Money. You are watching a live stream or you're watching this in the replay. Either way, welcome to you. Please ask me any questions about the content we're talking about in the comments. Anything related to what we're talking about investing, personal finance, business. These are the things we talk about here on Be the Boss of Your Money. That's the name of the show because I want you to be the boss of your money, not your money to be the boss of you. Today's big topic, the story of the day. Apple Computer reached a $2 trillion mark after about 2 years of hitting the $1 trillion mark. And even from the pandemic low, it's added probably close to about 700, $600 billion. That is a remarkable feat. Does it signify anything? Does it signify nothing? Does Apple deserve a $2 trillion market cap? Does it not? And what does it mean for the rest of the market for your investments? What does it mean for the future of the economy and for your personal finance? These are the things that we're going to talk about. And before that, we always go through a quick rundown on the day's action with perspective to help make you a better investor. So let's do a quick roll of the intro, and we are going to get started. You're not going to want to miss this. And we are back. Thank you very much for joining me. I'm Mitch Goldberg. I'm a financial advisor with the wealth management firm Client First Strategy. This is the show that you go to learn about personal finance, investing, business, and all of the topics that are related to those. Sometimes I have terrific guests on as well. So stick around, keep an eye out on social media for my posts about upcoming shows, and you'll know. Today, the big story. Apple hits $2 trillion in valuation. It's really the most remarkable thing that we have ever seen. So when I say Apple hits $2 trillion, we say it like it's nothing. And I'm kind of sick of talking about the same stocks, Microsoft, Apple, Facebook, Amazon, Google, Netflix. But that's where the action is. But it signifies something for the economy. But let's go through the update. We're going to talk about the market real quick. What happened today? Dow is off 85 points, S&P off about 15. Even the NASDAQ was off 64 points. So NASDAQ, the worst part of the day. Counter to that is the small cap. You see that says Russ 2K? That's the Russell 2000. That's the main small cap index that we follow. When small cap companies are doing well, that's actually a good sign for the economy. It's actually it's a positive. But up 0.15% after being down yesterday and underperforming the other major averages. It doesn't really move the needle. Okay. The VIX continues to sit in the low 20s, 22 and a half, up barely. I know it was up 4.79%, but for the VIX, that's a normal move. So what happened? Why did the markets go down? They were up. Apple hit $2 trillion valuation. It didn't close at a $2 trillion valuation. It just hit it intraday and then closed a little bit lower than a $2 trillion valuation. Not to sneeze at 1.99 trillion or something, but the point is, as soon as Apple hit $2 trillion valuation, I think investors started to get a little skittish. They started to feel like they're getting a little bit of a nosebleed. And then Fed Chairman Jerome Powell came out, with the Fed notes from their July meeting. It said they see, weakness continuing as far as they can see with the economy. The economy still needs support. It still needs help. It needs monetary easing. It needs low interest rates. It could use more stimulus. All of the things that have been done but are starting to wear off. The problem with stimulus is you get a sugar high from it and it wears off. And that seems to be happening. The stimulus packages over the years have gotten bigger and bigger and bigger. And we seem to be, forgetting about them a week or two later, they become old news. Okay, so let's go to the next screen. The big news again: Apple becomes first U.S. company to reach a $2 trillion market cap. That is remarkable. It's hard to say what $2 trillion means, but when you talk about $2 trillion, it's the biggest company in the world, and it's probably, I'm going to say off the top of my head, a good 6%, maybe 7% of the S&P 500 index, which is a market cap weighted index. So that is really just, it's mind boggling. So the question is, does it continue? What does it mean for you? I want you to know that I have a lot of these tech stocks. We're going to talk about that. I want to get into that, but there's other news today that we should take a look at. Target was up. I don't know if you could see that on your screen, but Target was up $17 a share. Is that better? Up $17, 12.5% today. Okay, that's the bottom one. That's during the regular session. That up 0.46. That's at 0.59. That is aftermarket. Why was Target up so much? Target reported their earnings today. Not only did they blow away street numbers, Home Depot blew it away, Lowe's blew it away, Walmart blew it away. Just incredible earnings and revenues figures. But Target, their online sales were up 197%. Oh, well, 197% year over year. Target is doing such an amazing job moving customers to online. You know, we all talk about Walmart competing with Amazon. I actually think people are looking at the wrong competitor. It's more like Target competing with Amazon. And it's just remarkable. But it tells you something about the economy. We'll get into that. Let's take a look at U.S. movers today. Target, the clear leader of the day. Twitter had a good day. Charles Schwab had an okay day. Regeneron had an okay day. Decliners. You know what's interesting? Gilead just keeps going down. That's the company that came out with the drug remdesivir, which is right now the only treatment approved for COVID. And that stock, ever since then, just goes down and down. Biogen was off a little. Just, no real major standouts with majorly known companies. In the Dow, Nike was the winner. Visa was up. Visa continuing to hold on to that $200 mark. Coke, Disney holding up okay. Nothing major. There were no major ups or downs. Really, the whole story was about the FANG stocks and Apple. Okay, so let's take a look. Facebook up a touch. Apple barely up on the day. That stock was up quite a few dollars more in the day. Amazon takes it on the chin, down 1.5%. Netflix down 1.5%. Google, which is Alphabet, down 0.78%. Microsoft down 0.6%. No wonder, the S&P with a giant weighting of tech stocks and the NASDAQ couldn't hold on to positive gains, because the FANG stocks basically had a pretty, a weak performance. I don't want to say piss poor or anything like that. Let's not use hyperbole. Just a weak day. And then with the last thing, this is the big thing. After this, I'm not going to do the share screen anymore today. But financials, even though they were the best performers of the day, they were still weak. Every sector of the economy, all 11 sectors, were down today. But the losers of the day, real estate, energy, consumer staples, just, yesterday was kind of a day where there was a little something in it for everybody. And today was just the opposite. There was like nothing in it for everybody. That's just the kind of day we had. But if you see financials and industrials and energy strong, that's a good sign for the economy. And that's what I want to talk to you about real quick. All right. So we're going to get through this in a couple of minutes. If you have any questions out there, listen, hit me up. Don't be shy. Ask me a question. The interaction between us is like my favorite part of the show. Okay. I see some people out there. Leo's out there. Tom. Hey, Mark. Good to see you. I haven't seen you around for a while. So thank you very much. Hi, Judy. And we have a couple things to go through. Okay. So the Target earnings came out They blew away street expectations. Online sales up 197%. That's incredible. Stock market, the S&P uh, hit a new all-time high yesterday, a closing high, backed off it just a tad bit, nothing to panic about. But a lot of people are not really jovial, ebullient about it. Okay, euphoric. I could go on with a few more words, but the economy is still very weak. And when these big stocks go up, the targets, the big FANG stocks, it's not telling you that the economy is well, and that's why the stock market is up. It's actually telling you right now that the large cap companies are the only game in town. These companies, as far as, not forget stocks for a second, as far as operating businesses, they have basically eaten all of the competition. They've been allowed to stay open. Target and Walmart have been allowed to stay open because they're considered essential businesses because they sell food. Just every advantage you can possibly think of for large cap companies has been around. You might not think of Target as one of the big tech stocks, but when you see that their internet sales are up 200%, online sales, Target is now basically an online company. They could probably cut a lot of stores and do even better. Their margins would probably go up. It's a nice advantage to have all the stores because they're fulfillment centers. It's easy to return things. That's why a lot of people like to buy online from Walmart, because they feel, if I don't like something, I can always run to Walmart and return it. I have no problem returning things to Amazon, unless it's something like big and bulky, but you try to be careful. So that's why a lot of people are a bit, they're not really in a celebratory mood because, the market's hitting highs, because the economy is still really weak. I know the economy the stock market has been touted as, hey, that's a good report card, a good scorecard. But if you are a consumer out there, and many of you are, I talk to people about this all the time, you're scratching your head saying, how could the stock market be so good when the economy stinks? I have friends who lost their jobs. My kids had to move back home with me. People are having trouble paying mortgages, forbearance on rent, forbearance on mortgages, et cetera. And some companies did say, like Walmart, that one of the reasons they did so well was because of stimulus money, the extra $600 per week that people were getting. And they said they saw a slowdown in foot traffic when the stimulus ended. The CEO of Target said that he thinks they're doing so well because people aren't spending money on vacation, so they're spending money on items from online retailers. But none of this reflects a good economy. It just reflects that stay-at-home, work-from-home companies have every advantage you could possibly think of, and small businesses have every disadvantage that you could think of. And small businesses are major employers. Large businesses are trying to eliminate employment. Look, I'm not trying to get on my high horse and social causes here. I'm just letting you know why these companies are doing so well, the big companies. Apple Computer, $2 trillion. I don't want to get into should you buy Apple or not right now. I mean, if you're looking for like a binary trade, is it going up or down in the next couple of days? I'm not going to really be able to help you with that. And I certainly don't want to get into that on my live stream. But if you are a long-term investor, you have to think, what does this $2 trillion mean, this market cap on Apple? Is there a limit to how big a company can become? The market cap, if you take all of the shares of Apple and multiply it by Apple's current stock price, that number gives you the value of Apple, of a company. That's the market cap. The value of a company is, fancy name is market capitalization. All right. So the market capitalizations, aka market caps, aka company values, do they deserve to be this high? Amazon, Alphabet, and Microsoft are all in the $1 trillion plus market cap group also. And I expect to see more companies possibly joining that crowd. Is it too big? Does it signify an end? I mean, Apple, people are paying twice as much for Apple's earnings on a PE basis than they were a year ago. Apple at 30 some odd times earnings. That's always been like a 10 to 15 times earnings PE ratio, because Apple is always considered a hardware company, and eventually hardware companies run into trouble. They don't innovate fast enough, or someone else comes out with a better mousetrap. They're being valued now more like a service, SaaS, software as a service company, cloud business. So that's all well and good. But at what point do we have enough cloud capacity, or what point do we have too much cloud capacity? I remember in the year 2000, we needed more chips, more cable boxes, more DSL, digital subscriber loop boxes. We needed more equipment and more equipment, just constant need for more hardware to get people on the internet. Now it seems the demand for hardware is insatiable, and the demand for more bandwidth is insatiable. But at some point, like 2000, you have to be thinking, does it get to be too much? Do we reach the point of overcapacity? We could be there. I really don't know if we're there or not. Every time I was thinking about could we be there, we're not. So I don't want to be guessing. But here's the the strategy. Okay, you develop an investment plan either with a financial advisor or on your own. You do it with investments that you could stick with, that you can follow, that you can understand. For some of you, that might just mean an index fund. I have no problem with index funds. I use index funds with my clients. Okay, so I'm not one of these financial advisors who're going to say, "Oh no, don't use an index fund. It's passively managed." Nothing. Listen, these are all tools: active managed, passively managed. These are tools, and I use the right tools to build the right portfolio for my clients. And by the way, investing is only part of the overall financial planning that I do for clients. We take into consideration many other factors of your financial life. But as far as the investing goes, we are relying on the stock market to build wealth and to stay ahead of inflation and to have this big pot of money when we finally get to retirement. And we don't want to be in a 10 or 15 year lost decade like we had from like 2010 to 2020. Well, really not quite 2020, but from 2000 to 2010, it was like a lost decade, especially if you were in tech stocks. So my thing is, if you're investing in a 401k plan, you're investing outside of a 401k on a monthly basis, keep doing it. You'll buy more shares for the same amount of money when the market is down. You'll buy fewer shares when the market is up. Keep doing it. Keep sticking to a portfolio that you can stick to, rebalance, reinvest. Bottom line is, instead of always looking for the hot stock or asking me, well, should I buy Apple now? Maybe it'll get a $4 trillion valuation. I'm allowed to say I doubt it. It could. Maybe. But instead of worrying about, should I pick up the next Moderna stock, the next hot stock, the next Tesla, worry more about your personal financial habits, saving money first before you spend money. Become an expert on what your biggest expense is. If you're big, that's taxes. If taxes are not your biggest expense, when you get older, they will become your biggest expense. Become proficient in the areas of personal finance. Believe in the process. That will take care of your results, as opposed to spending time contemplating, is Apple too high? Doesn't mean that at that point that it has to go down now and it's going to take the whole market down. Or is there some kind of natural limit on how big a company could be? If this pandemic has taught us anything, is there's no limit to anything anymore in terms of the business world, the health world, whatever you want to talk about. Certainly goes in politics now also. There are just no more limits to anything. So who knows if Apple has ran its full course or if the stock can keep going up. But if that's what your whole financial future is based on, I'm here to tell you, I think you're making a big mistake, and you really need to focus on your personal finance and becoming great at that, either on your own or with the help of someone like me. Either way, that is what I want everyone to focus on. Having said that, I would like to thank you for watching. Be the boss of your money. I do take this live stream very seriously. Your time is very valuable to me because I know your time is very valuable to you. So I hope I always provide value to you. Thank you, and I'll see you tomorrow.